Hi, I'm Melissa Joy, President of Pearl Planning, and I'm here to discuss the One Big Beautiful Bill Act and your money. There is a lot packed into the new policy legislation passed by the Republican Congress and signed into law by President Trump on July 4th, 2025. And this is all about, from a financial planner perspective, what a typical American or someone who works with a financial advisor should be aware of in terms of how the policy and legislation will impact your money. My primary focus is on taxes and their changes, but we're also going to talk about some other overall economic and financial impacts that Americans should be aware of. So to get started, let's just talk a little bit about the bill. First of all, I will note that this bill was signed into law, and the official name is the One Big Beautiful Bill Act, similar to the Inflation Reduction Act, which many would say under President Biden is speculative whether that particular piece of legislation reduced inflation. So there's a lot of editorializing going into bills, and also their names can be quite long. And I, in some cases, like in a recent blog, trimmed it down to OBBB, or I really like the summary of OB3 law, because we're going to be referring to this probably for quite a while. But one of the first things that comes through in this law is that you make permanent tax brackets. And in federal tax law, permanent means like no scheduled change. But as we know, if you follow tax law, there are changes frequently, at least a couple times every decade, if you were to average things out. But there is no scheduled sunset for the tax brackets. In fact, we'll have permanently the 10% bracket, 12, 22, 24, 32, 35, and 37, both for married filing jointly as well as for single filers, and then a separate bracket for head of household, or deduction, I should say, and then brackets for estates and trusts. So just keep that in mind. And then that is an extenuation of the 2018 Tax Cuts and Jobs Act, which was where most of President Trump's kind of tax brackets and much of the legislation that is incorporated into this bill as it is associated with taxes can be found. And then in that bill, everything would have been expiring and going back to previous law as of the end of this year. And thus, the permanency is that now everything's extended to be pretty similar to what it has been in the past. Meanwhile, standard deductions are going up slightly from 30,000 to 31,500. And for many higher income Americans, and I should say that's for married, from 15,000 to 15,750. If you're a single filer, and head of household goes up similarly. This is going to be one of the main places for change. If you're a very high earner, there's just going to be a slight, if you're standardizing your deduction, increase in or decrease in what taxes you owe because you have a higher standard deduction. And then there are new deductions for seniors, particularly one thing that's been touted by the legislation and in follow-up communications from the Social Security Administration is that, the headlines say no taxes on Social Security. What the fine print says is that fewer Americans who receive Social Security will be subject to taxes on that income. But the way it's going about is not to strike out tax cost for senior citizens and their Social Security, but instead to have a new deduction that's $6,000 for senior citizens. The phase out starts if you make more than a certain amount. For example, if you receive pensions or have larger retirement accounts that you have required distributions for, or just taking money out of your retirement accounts because you need them, then you have a phase out starting at 75,000 if single and 150,000 if married filing jointly, where above that income you will get less and less of a tax break with a $6,000 tax deduction until it's fully phased out at 175,000 for single and 250,000 for married filing jointly. Also, though, keep in mind, this is not a full abolishment of Social Security. So the 85% of Social Security benefits being taxed for those who do have taxable elements in terms of their income ranges will still apply. For kids and those who have minors, the child tax credit will be increasing to $2,200 per child. That's going up from around $2,000, and a phase out begins at a reasonably high income rate of 200,000 for single filers and 400,000 for married filing jointly, being fully phased out at 244,000 and 444,000. So just something to keep in mind. And then there's a brand new account called the Trump account. You may have heard it referred to as a MAGA account when it was being floated in early summer, but the name changed. And this is a new account for children under age 8. It will be funded with a pilot program for 2025 through 2028 with $1,000 per child. And then you could put in up to $5,000. And then it kind of works like an IRA where you get taxed when you take money out, but this can be kind of a pre-funding account for children. I'm not a huge fan of one more account to keep track of, but maybe that's just me because there are so many accounts already, including accounts for kids, which include former education savings accounts plus 529 accounts with a variety of rules and flexibilities, plus uniform trusts or gift to minors accounts. And so as we kind of expand the list of accounts that we need to keep track of, I'll just keep my eyes peeled to see how these actually get issued. We're not going to be seeing these types of accounts likely until 2026. They're likely to be available about a year after the bill was passed. So look for more information next summer, but retroactively, kids born this year plus kids born in the next 3 years after this year will be receiving a small amount put into the accounts. And that's never a bad thing for those kids. Itemized and standard deductions, things to keep in mind. We already talked about the standard deduction, which is quite high relative to where it used to be way back, at least now, prior to the Tax Cuts and Jobs Act in 2018. So 2017 and prior, many more people were likely to itemize because the rules for itemized deductions were more flexible and the standard deduction was lower. Then you have the Tax Cuts and Jobs Act, and in order to pay for some of the lower tax brackets, there needed to be some trade-offs, and those came in itemizing, also targeted towards states that may have been more supportive of candidates other than President Trump. So this particularly hit coastal states like New York and California. But after the Tax Cuts and Jobs Act, there was a huge drop in terms of itemizing. In fact, those using the standard deduction nearly doubled, and itemizers fell to less than 10%. Also, there were some limitations to itemizing called the phaseouts, and those are permanently terminated, as well as miscellaneous itemized deductions, which really matter for people like financial planners and if you pay for tax planning or tax preparation. You used to be able to deduct those expenses and investment expenses as well, and you can't do those nowadays. These again became permanent in law. The mortgage deduction was capped during the Tax Cuts and Jobs Act, and that cap was made permanent. I will note here that that cap was $750,000 as of 2018. It remains $750,000 today, although many other parts of deductions and phase outs, et cetera, are linked to inflation. And if you took $750,000 in 2018 dollars with high inflation since then, you would have that cap approaching $1 million today. So that benefit of the ability to itemize your mortgage interest being capped at $750,000 is becoming more and more costly for those, or less and less of a benefit, I should say, as inflation happens over time. And that was codified without a cost of living adjustment today. So that's certainly something to take note of. And then there have been tweaks to charitable deductions as well. If you itemize, your charitable deductions will remain with ability to deduct it up to 60%, but there is a haircut that you have to take on 0.5% of your adjustable gross income. So if you report $100,000 in adjustable gross income and you made gifts of $5,000, then $500 would not be deductible. So only $4,500 would be deductible. So that's a new wrinkle in terms of legislation. Now, the biggie, though, and one of the things that was fought over the most, even within the Republican Party, is state and local tax deductions. Because state and local tax deductions used to be just anything you paid in taxes for, your property taxes, your state income taxes in high income states, etc. You could itemize if the math worked. But with this new legislation, well, everything went down to a $10,000 cap, which was deemed to be very punitive to coastal states, especially that had higher tax rates. This chart highlights California, New York, New Jersey, but it caught a lot of people, regardless of their state, with a less and less ability to itemize and, kind of having to put up with lower tax costs. These are particularly for high income individuals. With this legislation, particularly even within the Republican Party, people fighting for Republican districts within these high tax, high income states were fighting to get that deduction cap wiped out. What they came up with in terms of compromise, or what came out of the bill, is that up to $40,000 can be deducted between the years 25 and 2029. That will be indexed by 1% per year, so probably not keeping up with inflation. But keep in mind, this is only going to affect some high income Americans, because that there is a phase out starting at $500,000 of adjustable gross income if you're joint, and $250,000 of adjustable gross income if you're single or married filing separately. And so this is going to be phasing out, and for the highest earners. And this also is only going to be in effect through 2029. So basically through most of President Trump's term and whatever's next. But then it will sunset. So not a permanent solution. And why is that? Because it's expensive to implement this along with tax cuts. But certainly it really matters if your income is right around that $500,000 mark, if you can control it to be lower. And every year is going to matter and be different depending on your income if you're in those higher earning brackets. Now, there's also some new separate deductions, and we've heard about them, these as headlines, but when you look under the hood, there's more details that you need to be aware of. So you do pay taxes on tips if reported in terms of your FICA, like your income taxes, set aside withholdings for Medicare and Social Security. But you can get a deduction that may mean that you didn't necessarily report on your tip income. It's up to $25,000 deduction annually. But again, on tips, that income phases out when you get between $150,000 and $300,000, depending on how you file. And this is only going to be in effect from 2025 to 2028. So it's not permanent. It has a sunset. You can't just go and say, hey, I provide financial planning services, but now I'm going to code those services as a tip. That's not going to be the way it works. It's going to be, kind of standard descriptions of tips, and the Department of Labor or the Treasury is going to clarify on exactly how they're going to make sure that there's not loopholes where everybody is reporting their income as tips. And if you're a worker who receives tips, you need to be able to distinguish between your regular income and that tip income. So there may be additional reporting requirements for the employers. Additional deductions are also for overtime. Again, income phase outs between $150,000 and $300,000, depending on how you file. That's a $12,500 if single, and $25,000 deduction that can reduce your reportable required taxes on overtime pay. Also, if you love to give to charity, but you haven't been able to get a tax break because you don't have the right situation in order to itemize, and you're just doing a standard deduction, starting next year, not this year, you can deduct $1,000 if filing single and $2,000 if filing jointly of just any type of charitable contribution. And then finally, there's a new car loan interest deduction. Again, this is only for 25 through 28, and that is a $10,000 deduction for certain types of vehicles. You need to make sure that you're buying a new vehicle. It's not a lease, that it has final assembly in the United States, and it's a loan that needs to be drafted now or in the future. It's not for previous car loans. And so, again, these are like specific wrinkles that you need to be very aware of your personal situation so you have more clarity on what you're going to be paying. Also, in the new legislation is phase outs for clean energy credits. Everything is accelerated so that it is, or not everything, but most clean energy credits, whether it's personal or business investment, are greatly reduced in terms of the length of time that they'll be available. Some phasing out as soon as the next few months. And then others expiring in 2026. Most of those credits previously had been available through 2032. Wind and solar are particularly targeted, with less targeting on nuclear and some other energy considered to be renewable. But if you had plans to buy a car with getting an energy credit, solar panels for your home, look into the fine print, because especially in conjunction with tariffs that may be associated with some of the materials that you're looking for these may have radically different economics in terms of viability. There are some considerations. I'm not going to spend a ton of time on this, but for the highest net worth, either earners or people with assets, one is that um, alternative minimum alternative minimum tax, also known as AMT, generally applies to fewer and fewer people nowadays. But if you have particularly incentivized stock options, then you may be familiar with AMT if the companies that typically have IPO'd have done quite well. Well, AMT is going to remain, the exemption is going to remain high, but not as high as it would have been with current law. So it's reverting back to $1 million if married, filing jointly, and $500,000 if single. And so careful planning and consideration, if you happen to fall into the brackets that are subject to AMT, would be wise. And then also, the estate tax is something that really came up in the campaign year last year, especially for estate planning attorneys and CPAs, saying, hey, you may need to do radical, aggressive kind of gift planning because estate exemptions could go much lower than they had been. You'll see in this chart on the right, this looks back in my entire career to what the estate tax exemption has been over time. And you'll notice that it has been as low as $600,000. Well, now we're looking at estate tax exemptions, which basically means like, hey, if you have less than this amount of money, you don't need to be concerned about federal estate taxes if you died during the regime that has these rules. Is 15 million per person. So for a joint household, it's 30 million. This is starting next year. It's a bump up by about 7% from the ranges that they're in today, which are in the 14/$28 million ranges. So there's a wide, kind of margin for typical Americans and even very high net worth Americans where estate taxes are not a concern. And if you are in those ranges, there's also some opportunities to be more sophisticated with the planning strategies while these remain quite high. A lot of business owner considerations for small business owners. I'm not going to go into everything in great detail, but do know Section 179 deductions with increases to 2.5 million in terms of, and phase out at 4 million, are becoming permanent and indexed for inflation. This basically means that you could fully deduct things that would otherwise have been on a schedule for deductions. Same goes, and in conjunction with this, for bonus depreciations. Qualified small business stock exclusions are a way, especially for startups and kind of venture capital companies, but may apply for small business owners that don't particularly consider themselves to be that, kind of venture capital oriented, where you can get a deduction and save big time if a business is sold, and get a significant reduction in taxes. And so these rules are becoming more flexible and higher. And then the qualified business income deduction has been permanently indexed with inflation and is sticking around. Additional incentives that employers should be aware of include the ability to contribute to your employees' student loans without having that be taxable income, a credit if you have paid family leave as part of your benefit policies for your employees, or you're paying for premiums for short term disability policies, the ability to do charitable giving and get deductions for that, as well as child care incentives. Those are being made permanent. And then even bigger small business retirement plan credits if you're making those available. I'll just say that there's a lot in here for business owners, and you need to be asking your tax preparers, your financial planners, your advisors, those that work on your retirement plans, hey, is there anything else I need to be aware of? Because there is so much out there, and there's a lot of consideration for business owners. Here are some additional things that I think may impact your money. The debt ceiling was negotiated into this legislation, and it's being raised to $5 trillion. So basically, at when there's $5 trillion of U.S. federal debt, which, believe it or not, is coming up within a few years, it's projected to be through 2028. Then Congress will need a deal where they have an agreement for how to increase the debt ceiling again, or else they will have the very real need for a government shutdown and reduction in how the U.S. pays its bills. So basically, this has been tied to kind of the election year and the year after. So it gets kind of the debt ceiling out of President Trump's hair for a considerable period of time, or perhaps his entire presidency. Medicaid and SNAP benefits have increasing requirements to prove that you're looking for work if you're able-bodied, that you're required to report more frequently, show that you're trying to work or you are working. This not only will likely impact the particular people who it's intended to impact, but for example, Medicaid cuts in a healthcare ecosystem are going to make it inherently more difficult to provide healthcare services to those of you who are in rural areas that are more distant from, kind of city centers that have more of a medical industrial complex. So it's definitely something to be aware of. This definitely can impact, if not you, family members. And then there's actually good news for flexibility when it comes to 529 plans. These can now be used increasingly for not just kind of higher ed for academia, but also very important, kind of on the work training, whether it's apprenticeships, tutoring within school, therapy for certain disabilities, some homeschooling. You can do student loan principal repayments with 529 benefits, but I'll say we don't see that come up very often, because if the 529 funds existed, how did the student loans kind of start in the first place? But even, for training for something like the certified financial planner, that training wouldn't have otherwise in the past been eligible for 529 usage, but would be today. I do think generally it's becoming more difficult to pay for higher education. This law, I don't break it out here, but includes taxes on endowments of large institutions, those with more than 3,000 students. Meanwhile, Parent Plus loans are becoming more limited in terms of how much you can take out and how much you can take out per year. There's limitations on grad student loans. So I think, kind of the hard and difficult already economics of paying for college for kids is not going anywhere. In fact, getting more difficult in many cases. So the need to plan and save for college, if that's a critical priority for you and your family, is only getting higher. In fact, I did break it out. Here it is. Caps on borrowing, grad plus loans, Pell grants are being expanded, though, to non-degree programs like apprenticeships and on-the-job training. That's good news and more flexibility. HSAs, their contribution limits are increased. They're being indexed for inflation, and more health plans are eligible, including catastrophic plans that cover very little except for the biggest expenses, as well as bronze plans. And there's new reporting requirements for those who are investors with cryptocurrency that are put into this legislation. What should you keep in mind when you think about financial planning in light of the big beautiful bill act? Well, first of all, I'll say that taxes are going to continue to be so important. Nothing in this bill makes anything simpler. I'll say that there's going to be more reporting requirements, more things to sort through. I don't envy CPAs, nor do I envy, tax software creators. But I think tax awareness is such an important part of financial planning in general, certainly when it comes to investing, but also just for all of those decisions. You want to pick up tax breaks when you can get them, but also be aware of what's coming and not surprised. And so taxes importance is not going anywhere. For many people, they may be on the threshold of certain breakpoints. So they really need to keep in mind where their income is. And certainly that's something that we focus on as financial planners. And also, some of these provisions will be really easy to get comfortable with. Think of that senior tax deduction, but then it's going to phase out around 28, and in some cases 2029. So while much of the law is considered permanent or until things change, other parts are set to phase out. That's just how they had to do it in order to be able to quote unquote pay for it. Although I think the implications are that much of this bill, because there's not associated spending cuts along with the tax cuts, is going to rely on more and more debt and deficits. If you have questions, if you're someone who's working with a financial planner but taxes aren't a consideration, if they're not having this dialogue about the new kind of information, do not hesitate to reach out to my team. You can go to pearlplan.com/contact and schedule a meeting with one of us to talk about how we do things differently. We have newsletters available that you can sign up for from the website, a weekly podcast, and we do webinars like this on late breaking financial topics that impact many people like our clients and you. So do not hesitate to reach out. It's always important for me to include disclosures. And with that, good luck diving into that bill. In our video notes, we will include a link to our website as well as a link to a lengthier blog that we wrote on all of these topics. And with that, have a great day.